I will start with classwork 1, and classwork 1 is from November 2020. It's for 45 marks, and you need to complete this in 27 minutes. There's part A and part B. Part A says that Win Limited is a company that sells medals and trophies to club hosts and running events as well as to schools. They make use of periodic inventory system. The financial year ends on the 30th of June 2021. They value their inventory as follows. Medals they use weighted average method, and trophies they use first in, first out method. Now, information relating to medals, they say that medals arrive in boxes of 50 and have a delivery fee of 75 per box. So basically, they're telling you that each box is 75 Rand, and inside each box, they arrive in boxes of 50. Well, they didn't specify how many medals in each box. So we know that they arrive in boxes of 50 and have a delivery fee of 75 Rand per box. There were 5 boxes worth 2,034 on hand. And that was on the 1st of July 2020. Note that the end of our financial year is June, so the beginning will be the 1st of July 2020, and they said this includes their delivery cost. Their computer shows that 34 boxes were purchased throughout the year for a total of 15,190. That includes their delivery cost. So that is good, because if delivery costs were not included, you were going to have to include them in the cost price of those boxes, as they make up the cost price of trading stock. One of these boxes costing 470 had been returned to the supplier. The delivery fee is non-refundable. So they said one of these boxes. So one box was returned, and the value of those boxes will be, of that box will be 470. You don't need to minus 75 Rand, which is the delivery fee, because they told you that delivery fee is non-refundable, so you lose it. So basically, the whole cost will have to be subtracted from the total cost of available units. All returns relate directly to the purchases in the previous month. That is important. I will simply highlight that. So basically, if you return medals in August, it means that they were purchased in July. If you return them in Feb, they were purchased in January. That's what that means. And then they said the stock take on 30th June 2021 showed that there's 7 boxes on hand. So we need to calculate the value of 7 boxes. But because we are dealing with medals, and they told us that each medal is sold for 30 Rand, a total of 27 boxes were sold. So we can calculate sales and cost of sales there. But we know that medals are simply valued using weighted average method. So when we calculate, let me just see what the first question requires us to do. The first question wants us to calculate the cost of one box of metal on 30 June 2021 using the weighted average. So for us to calculate one box, because there are a lot of boxes that were purchased, so we wouldn't figure out how much each cost, how much each will cost. So we'll have to use weighted average. The value of your opening stock was 2,034. The value of your purchases was 15,001. To return the cost of one box that is returned is 470. The number of units that go with that 1,034, it was 5 units. We purchased 34 boxes and we returned 1. So it's the value divided by the number of units. Value divided by the number of units. So the cost of each box will be 440 Rand and 89 cents. To calculate sales, they told you that there were 27 boxes that were sold. Each box was sold for, let me just read that quickly. They said that medals are sold for 30 Rand each. So each medal is sold for 30 Rand, and a total of 27 boxes were sold. So you will simply, in each box, there are 50 medals, if I'm not mistaken. So you will simply take 50 times it by 27. Let me just check quickly. It says each is sold for 30 Rand. A total of 27 boxes were sold. Yes. So it'll be 30 times 50 per medal, and then you times by 27 because there were 27 medals, and that will simply give you the selling price of all the medals, which will be 40,500. To calculate the cost price, you will use this method. Opening stock was 3,034. Purchases was 15,090 minus your returns, which will give us net purchases of 14,720 minus the value of your closing stock. Remember, 7 medals were remaining. Each medal will cost you 40,089. Let me just confirm that how many boxes were remaining or how many medals were on hand at the end of the year. They told you that showed a total of 7 boxes on hand. And we know that each box will normally cost you 440,89. Okay, which is what basically they have done here. Right. So what we did in the previous one, we simply found the selling price of one box. So the selling price of one box will be 30 times 50 because there are 50 medals. And obviously they were, so it's 30 times 50. So one box, we sold it for 1,500. And in total, as I've said in the previous part or the first part of these workings, in total, we sold 27 boxes. So basically 27 times 1,500 gave us the selling price of 40,500. So everything we do here is in terms of boxes. The value of 7 boxes that were remaining will be 440 times 89. And 440 times 89 will give us 3,086,23. To calculate the value of your closing stock, you will take 2,034 and you add 14,720, and then you subtract 3,086,23. So let's see, it's 2,034, you add 14,720, and then you minus 3,086,23, and the cost price of all boxes sold, which is the cost of all boxes sold. Cost of sales is simply all boxes sold, only 13,667,77. Calculate gross profit, you will take 40,500 and then subtract that 13,667,77. All right, because there was no coverage on purchases, so we'll simply read it out. Okay. That is our gross profit will be 26,832,23. Now we need to calculate the value of closing stock of trophies. Now to calculate the value of closing stock of trophies, let me just read the table quickly. We know opening stock is 550 and the cost of each unit was 200 in total. The cost will be 110,000. We purchased 1,420 units, and obviously in total that will give us 538,000. Now in October on the 5th, we returned 50 trophies, and those trophies, if they are returned in October, it means they were purchased in September. And then we returned 42 in March. Those were purchased in February 2021. So in total, we returned 92 trophies. All right. So the cost price of 50 trophies will be 200. The total cost of those 50 trophies will be 20,000. The cost price of 42 trophies will be 300. Yes, it will be 300. And we'll take 300 times 42. It'll give you the total cost price of all those 42 trophies that were returned. Now, how do we calculate the value of the value of your closing stock? We don't have the number of units that are remaining, so we have to calculate that. So we need to first find units available to be sold. It'll be 550 plus 1,420, and then you minus 92. That will give you the number of units available to be sold. So let's just do that calculation quickly. So units available to be sold. Please check my previous videos on inventory if you get confused in this case. All right. You will take 550, you add 41,420, and then you minus 92, which is the 50 plus 45, 42 of boxes. So those are the number of boxes that were returned. and that'll be 92. So number of boxes available to be sold will be 1,878, but we only sold 650 boxes. So we are left with 1,228 boxes. But because this is first in, first out, we know that what will make that 1,228, the first thing that will be part of that will be these 700 units. But remember, from these 700 units, we are only left with 700 minus 42 with 656. Obviously, it doesn't make that 1,228. So we know that 656 of the remaining units were purchased in March. All right, so these are available units that we haven't sold yet. Of that, we know that 658 were purchased in February. So the cost price of those that are remaining from February purchases will be 197,400. And then let's see. The month before February, purchases, 100 units were purchased in December. There were no units returned for December purchases. So the cost of those units will be 100. But when we add 658 with 100, so let me just add it, 658, add it with 100, 658, add it with 100. Remember, it needs to make 1,228. So 658 plus 100, it gives you 758. Still not enough. So this doesn't make up the entire closing stock. So it means that how much is left so far of the units available to be sold, or basically closing value. So all I'm going to do is take 1,228 and then minus the answer that I got in the previous calculation, and that will give me 470. So to make up that 1,228, I need 470 units. So those 470 units, they'll come from September purchases. How many units to be purchased in September is 620, and out of the 620, we only returned 50. 620 minus 50 will give you 570, which is still enough. It means that 470 of the remaining units will come from the September purchases, because for September purchases, units available to be sold were 570, but we only sold the other part. We only sold around it's 570 minus 470. We sold 100 units of those, so we still remain with 170 units of those. So 470 units of the remaining stock will cost 400 Rand. Remember, last in will be part of your closing stock, and the cost price of the closing stock from those September purchases will be 188,000. Now you will simply take 197,400 plus 80,000 plus 188,000. It will simply give you the cost of the remaining stock, which is 465,400. And this is the cost of the 1,228. And those units that are remaining, their cost price will be 465,400. Remember that of the 1,228, 658 will cost 300. 100 of those will cost 800, and 470 of those will cost 400. Okay, and that's how you will calculate the value of your closing stock. And these are the units on hand, and the available will be 465,400. Now let's go to part 2. Okay, part 2 says that Jecorin Boisons, the owner of Win Limited, has decided to look at another business called Start to Finish Limited, which sells race t-shirts to race organizers. Due to the nature of this business 90% of, I will highlight this, I don't know if you want to use it, they say 90% of sales are done on credit, and meaning that 10% were for cash, because we allow our debtors 60-day interest-free payment. So we sell them goods now, but we only get money after 60 days. Now, the business is a registered vendor and they use the invoice. So whenever we sell goods, when we sell goods, that's when we recognize, we record the VAT. We don't record VAT when we receive money from their debtors because we allow them 60 days. And we know that VAT is charged at 15%. They're required to pay VAT every 2 months. The first transaction says that credit sales, note that sales income attracts VAT output. All right? VAT output is a liability. And when it's inclusive, remember that it means that it's at 115. So to find 15, you just multiply by 15 divided by 115. And they said the cost of these sales amounted to 66,000. Okay. 66,000 cost price, we don't record it because it was recorded when we purchased, because this is on invoice basis. When we purchase them, that's when we recorded VAT on it. We don't record it when we sell, that is when we receive the money, right? So on that 66,000, VAT on that has already been calculated. We just need to calculate VAT on the 75,000. So to calculate VAT output on that, we were told that already we had 33 rand, 50 cents, or is it 33,050? I'm not sure, which is on the debit. It means that that was VAT input. So question is, will VAT input increase or decrease? All right. So, okay, I don't know what happened. Let me just erase it quickly. Now, in those units that we purchased, we sold, which is from number one, it was 75,900. When you calculate VAT on that, it will be 75,900 times 15 divided by 150. It results in VAT output, and VAT output will decrease VAT input that was given to you. That's why we have a decrease, but that was recorded for you. Let's go to number two. Number two, they say we must also account for VAT on cash sales. Now, to account for VAT on cash sales, we first need to find cash sales. We were given credit sales of 75,900. To get cash sales, you will take 75,900 times it by 10 over 90. So that gives you cash sales of 8,433. Now you're going to take your cash sales and calculate VAT on them, because those cash sales, that 8,433, it's VAT inclusive. So you will multiply that by 15 divided by 115 to get the exclusive part of VAT, which is 1,100. Again, this will result in VAT output. VAT output will reduce VAT input. Number three, they say total credit purchases amounting to 2,070 VAT inclusive. So you will take 2,070, because it's VAT inclusive, you will multiply it by, it's 2,070 multiplied by 50 and divided by 115. It'll give you VAT on that, and VAT on that will be 270. Because that relates to purchases, it increases VAT input. Okay, they said the T-shirts to the value of 360 VAT exclusive were sent back to the supplier. We'll get to that, but we'll first have to record the first part of that, which is 270. 270 will increase your VAT input. That is why we have 270 there. The only thing that you need to put in is that 270, I don't know why they didn't record it. It increases your VAT input. Okay, it will increase your VAT input. Now, as I've said, it will increase your VAT input. Let's continue to the next one. Number four, number three, actually. We did number three, okay. Number three says that the total credit purchases amounted to 2,070, right? And T-shirts to the value of 360 VAT exclusive were sent back to the supplier. Please note that we are calculated that 20 and 70. When you take 20 and 70 and you multiply it by 15, you divide it by 115, it'll give you 270, of which I said that it will increase your VAT input. Purchases or income will increase your VAT input. Actually, purchases or expenses will increase your VAT input, and your income or your receipts, in essence, will increase your VAT output. VAT output is a liability, VAT input is an asset. It means that it needs to come back to us. VAT output, it needs to go to SARS, it needs to be paid to SARS, right? And let's just read further. It simply says that the value of 360 VAT exclusive shares were sent back to the supplier if purchases results in VAT input, increases VAT input, any returns basically to the creditor will reduce your VAT input. So basically, creditors' allowances, VAT on creditors' allowances will reduce your VAT input. That's why for 3B, we'll have 360 times 15 divided by 100 because they said 360 was VAT exclusive. That 54 will reduce your VAT input. Purchases, expenses, increase VAT input. Income or sales will decrease your VAT input or result in increase in VAT output. Let's go to number 4. Number 4 says that at that time, which is a SPS who bought goods on, well, in March 2019, 1,200 VAT exclusive has not paid his account. It has been decided that this debt will be written off. Expenses, as I've said, expenses and purchases result in increase in VAT input. So that 1,200, because it's VAT, they said it's VAT exclusive or inclusive. Let me go back to it. They said that it was VAT exclusive. So you will calculate VAT at 15% on that. And the amount of VAT that you get on that, which is 180, will increase your VAT input as I've specified. It does reduce your VAT output. And when you reduce your VAT output, you're just increasing your VAT input. Okay. The last one, it says that start to finish, which is us, settle their account. So settling our account, we don't need to calculate VAT on the amount that we're settling. However, they say we were rewarded with 690, which is a discount. So a discount will be VAT inclusive. So that 690, which gives us a discount received, will result in an increase in your VAT output, which decreases your VAT input. Okay, discounts and expenses, purchases. So your expenses, your purchases will increase VAT input. So anything that reduces your VAT input will actually results in VAT output. Anything that reduces your VAT input results in VAT output as I've specified. All right. And I hope you understand this. If you still don't understand this, please check out my videos on VAT. All right. And I think this will be it when it comes to calculating VAT. Now, since this is it, I'll just have to go to the next question, which asks us that if Joe has recently heard that start to finish is eligible to use the receipt-based method for paying VAT over to SARS. Would you suggest that she makes this change? What impact might this have on start to finish limited? Note that when you invoice basis, it means you calculate your VAT when you issue an invoice. But when you issue an invoice, note that 90% of these invoices are on credit. They'll only be paid after 60 days. So you pay before you receive money. So your payment before you receive money might affect your cash flow negatively. That's why I would encourage her to actually change to the cash method. But now please note that you can't just change because it affects the consistency of the business. And that is vital when you remember the GAAP principles. You cannot just change. You need to be consistent. So cannot, later on, she can't come back and say, oh yeah, I think I made a mistake. I'm going back to my invoice method. Okay, you have to be consistent, right? And I think it'll be easier to recall it when you receive that cash because 90% of these sales are on credit. And when you pay VAT before you receive your money, then you might experience cash flow problems, right? Now they say after 90 days, start to finish, charge 12% interest on any amount still outstanding from the debtors. Explain where the VAT on the interest income will be accounted for by the business and give a reason for that. And the answer to that, guys, is that no, because interest income is VAT exempt. Okay, interest does not add value, so it's a financial cost and it's a VAT exempt. All right. Thank you for watching. I hope everything made sense to you. That was a long question, I must say. Thank you again for watching.